Hello everyone, welcome once again to Vietnamese Call. Hope everybody is doing good. So today we are going to start episode 19 of Rift Before You Quit. Rise of Capital Identity. Why financial reputation may become more valuable than capital itself. For centuries, access to opportunity was determined by one question. How much money do you have? Banks asked it. Investors asked it. Lenders asked it. Institutions built entire industries around it. Larger your balance sheet, the more opportunities become available. Capital determined access. But something extraordinary is beginning to happen. For the first time in financial history, technology is making it possible to measure something else. Not how much money someone has, but how do they manage it? And that shift fundamentally reshape the future of finance. Because in the next generation of markets, reputation may become more valuable than capital itself. Welcome to era of capital identity. The problem with traditional finance. The modern financial system relies heavily on static measurements, credit scores, income statements, bank balances, net worth calculations, historical lending records. These systems work reasonably well, but they only tell part of the story. A millionaire can be reckless, a small trader can be disciplined, a wealthy investor can destroy capital, a modest participant can preserve it exceptionally well. Traditional systems rarely measure this difference. They measure ownership, not behavior. The future may measure behavior. Old financial identity was income, assets, credit score, access. New capital identity is behavior, risk management, consistency, trust, access. Ownership built the old system, behavior may build the next one. What is capital identity? Capital identity is the idea that financial reputation can become measurable. Instead of evaluating people based solely on balances, future systems may evaluate how consistently fund is managed, how risk is controlled, how exposure is allocated, how portfolios behave during volatility, how drawdowns are handled, how recoveries are achieved. In other words, the system evaluates a manager, not just the money. Imagine two participants. Participant A controls 1 million, participant B controls $10,000. Participant A automatically receives more attention in the future. In the future, participant B receive more trust if the behavior demonstrates superior capital management. Capital identity introduces a new possibility. Trust becomes portable. The components of digital capital identity. Risk discipline, portfolio stability, drawdown management, allocation quality, consistency, execution behavior, capital preservation, long-term performance. This all determine capital identity score. The coming age of on-chain reputation. Historically, reputation was fragmented. A trader could perform well on one platform, poorly on another, disappear and then restart, and begin again. Technology is changing that. On chain infrastructure creates persistent records. Actions become observable, performance becomes verifiable, history becomes transparent. For the first time, financial behavior can become part of permanent reputation layer. This concept may eventually become one of the most important developments in financial technology. Not because it tracks money, it tracks trust. Internet created digital identity, social networks created social identity. The next generation of financial infrastructure may create capital identity. And just as social identity transformed communication, capital identity may transform finance. Evolution of digital trust. Trust started with email, identification of email, then social identity, then professional identity, financial identity, and now capital identity. Why trust is the most valuable asset? Every financial system ultimately runs on trust. Banks operate on trust, insurance operates on trust, markets operate on trust, investments operate on trust. Without trust, capital stops moving. Challenge has always been measurement. How do you measure trust? Historically, institutions relied on audits, applications, references, interviews, track records. The future may rely on data. Millions of data points, every allocation decision, every drawdown, every recovery, every position sizing adjustment. Trust becomes quantifiable. Trust engine. Behavior creates data, data creates reputation, reputation creates trust, and trust gets capital access. The future of institutional allocation. Imagine two traders applying for capital. Trader A 500% annual return, 70% drawdown. Aggressive leverage, high volatility, short track record. Trader B 28% annual return, 5% drawdown. Stable allocation, controlled risk, 5-year history. Most institutions choose trader B. Why? Because institutions allocate capital, not excitement. The future may amplify this process. AI systems may eventually evaluate thousands of variables simultaneously, not merely profits. Behavior, consistency, exposure, discipline, trustworthiness. This creates a completely new financial landscape, one where reputation becomes infrastructure. The future allocators may analyze profitability, risk, consistency, recovery speed, portfolio stability, behavior during losses, behavior during wins, allocation discipline. Death of one dimensional trader. For decades, traders have been evaluated through single lens profit. Did the trader make money or lose money? That was the entire conversation. But institutional capital has learned something important. Profitability alone is one of the weakest predictors of long term survivability. A trader can generate extraordinary returns for 6 months and disappearing during the seventh. A trader can produce moderate returns for 10 years and quietly compound wealth. The difference lies in dimensions. Future capital allocators may no longer evaluate traders as one dimensional performers. Instead, they may evaluate multiple dimensions simultaneously: risk behavior, drawdown discipline, portfolio construction, capital efficiency, allocation consistency, recovery ability, market adaptability, behavior during volatility. Behavior during winning streaks, behavior during losing streaks. The future trader is not merely a performer. Future trader becomes a measurable operating system. Why prop firms alone cannot build capital identity? Traditional prop firms solve one problem. They identify profitable traders, but they often fail to solve another problem. That is continuous reputation building. Most evaluations occur within fixed periods: 30 days, 60 days, 90 days, and the trader passes or fails, the process ends. But the real capital allocators think differently. Institutions often evaluate managers across years, sometimes decades. A hedge fund does not receive capital because of one successful quarter. It receives capital because of repeated disciplined behavior. This creates a gap. The prop industry evaluates snapshots. Institutional finance evaluates histories. Next generation infrastructure may bridge this gap. Instead of measuring isolated performance events, systems may continuously evaluate participation behavior. Every allocation, every risk adjustment, every portfolio decision, every recovery cycle, every capital rotation. Over time, these behaviors create something more valuable than a challenge pass, a reputation. From execution to reputation. Most financial technology platforms focus on execution. Can a trade be opened? Can a position be closed? Can a order be routed? Can a transaction settle? These are important questions, but they represent the first layer of infrastructure. But the next layer is behavioral infrastructure. The next layer asks, how does capital behave? How does risk evolve? How does allocation change? How does performance persist? The future of finance may not be defined by execution infrastructure alone. It may be defined by reputation infrastructure. Every reputation influences. Okay, because eventually every transaction becomes history, and every history becomes reputation, and every reputation influences capital allocation. This transformation is already beginning. The market is slowly shifting from transaction based finance towards behavior based finance. How smart money creates the first layer of capital identity. One of the most overlooked aspects of modern participation systems is observation. Before someone can manage capital professionally, they must first understand how professional capital behaves. Most retail traders only see trades. Professional capital sees portfolios. Retail traders see entries. Professional capital sees allocation. Retail traders focus on outcomes. Professional capital focuses on process. Rift Smart Money introduces users to an entirely different operating model, trading books. Mirror wallet infrastructure, portfolio exposure, capital allocation, transparency, risk visibility. Instead of blindly chasing trades, participants gain visibility onto how professional capital is deployed, rotated, protected, and managed. Over time, this creates behavioral understanding, and behavioral understanding becomes the foundation of capital identity. Before capital can trust a participant must understand capital. How auto engine changes participation. Historically, traders faced a difficult challenge. Markets require continuous monitoring. Emotions create inconsistency. Execution quality fluctuates. Discipline breaks down. The Rift auto trading engine introduces a different philosophy. Instead of relying entirely on manual execution, participation becomes infrastructure driven. Alpha flow, smart flow, micro flow. Three operating environments. One capital framework. Each environment is designed to operate under different market conditions. This mirrors how institutional capital behaves. Large funds rarely rely on one strategy, they diversify participation environments, trend environments, precision environments, balance environments. The objective is not precision, the objective is participation continuity. And participation continuity creates behavioral data. Behavioral data creates reputation, reputation creates identity. This is where execution infrastructure begins evolving into reputation infrastructure. How Rift fits into this future? This is where broader vision becomes interesting. Many platforms focus on trading, some focus on execution, others focus on access. The future may focus on participation history. Rift Smart Money already introduces several foundational concepts: trading books, mirror wallet infrastructure, portfolio visibility, risk awareness, capital participation, performance observation. These
Okay.
systems create more than participation. They create behavioral records. And behavioral records some become building blocks of reputation. In the future, participation infrastructure may evolve into capital identity infrastructure. The journey could look like this: observe, participate, learn, build consistency, develop reputation, unlock opportunities, scale capital. This focus shifts from transactions to trust. Rift evolution model. Trading participation, behavior history, capital reputation, trust layer, capital identity, and then institutional opportunities. The capital passport. Today, people travel with passports. Tomorrow, capital may travel with reputation. Imagine a future where your risk profile follows you, your allocation history follows you, your consistency score follows you, your capital reputation follows you. Not controlled, not owned by one institution, not controlled by one company, portable. Verifiable, transparent capital passport, one reputation, multiple opportunities, global participation. The concept could fundamentally transform how financial access works. For generations, financial systems have rewarded ownership. The next generation may reward stewardship, not how much capital you control, but how well you manage it. Because the future of finance may not belong to those with the largest balances, it may belong to those with the strongest reputations. And if that future arrives, capital identity may become one of the most important assets a participant can ever build. Not money, not leverage, not access. Because capital eventually follows trust and trust follows behavior. Now next episode is going to be 20, which we will go on Monday. And episode 20, we will talk about the AI capital manager. AI portfolio managers, autonomous capital allocation, machine driven risk management, predictive capital routing, AI trading infrastructure, self learning financial systems, human versus machine performance, future of autonomous wealth participation. Because the next financial revolution may not be powered by traders, it may be powered by intelligent systems managing capital on their behalf. So I will see you all in episode 22. Thank you. Come on.